Welcome. It's great to be here with everyone from around the world. Let me start out by saying I am humbled by how many are attending the event tonight, and I hope that you find it valuable and helpful for you. In fact, I know that you will find it valuable and helpful for you. First, I just want to make sure everybody can see and hear me okay, and Doc as well. Okay, great. Yes, you can. Excellent. Thank you so much. Second, this is being recorded, and the presentation and the recording will be posted in the portal for all students, so feel free to sit back and enjoy. Lastly, Doc and I love doing these events and taking your questions, and we've set aside time to do so at the end today. So if you do have a question or a thought that comes up, please type it in the questions box so that we can track them, and I'll answer them when we get to the Q&A. Tonight, we're going to go on a little bit of a journey. We're going to review the top 3 lessons learned so far this year in 2023. We're going to cover some other takeaways, and I'm going to pull back the curtain and go in depth on bigger things happening in the financial system, things that we typically reserve for groups like the 12-Minute Mastermind. I'm going to share some of that insight with you. And then we also have some big announcements and enhancements and improvements to share that you don't want to miss that we'll cover at the end as well. I expect us to be here for about an hour and 15 to an hour and 20 minutes or so. All right, before we jump into this, as part of the housekeeping, I am required to show the disclaimer and let you know that neither Doc or I are financial advisors, nor should we be thought of as ones. This webinar is for informational and educational purposes only. You should always consult your financial advisor for your needs. You and you alone are responsible for your financial decisions. All right, with that being said, let's jump in. Since we have so many people from around the world on this event tonight, many of which are students, but some of which are not or maybe attending a 12-minute event for their first time, I'd like to spend just a few minutes to give you a little background on how we got here, tell you what we do and why we do it. So, who is Dave Lucas? Well, I started out a little over 20 years ago in my car making less than $1,000 per month in my first business. I was even dressing up as characters for kids' parties, serving, and bouncing in a nightclub to make ends meet. But I knew that I needed to learn what I did not know. So I went to work in a Fortune 500 for about 6 years and had a lot of success, where I ended up spending my extra time and weekends traveling to meet and learn from the most successful that I could find. I got to meet with people like Zig Ziglar, Brian Tracy, a number of millionaires, and even a couple billionaires, all with a goal of looking for the consistent habits and patterns that made them and kept them successful. I started to figure these out and put them into practice for myself, reaching more levels of success and then applying them to my next businesses. After some prodding, I wrote a best-selling book called The 10-Year Career, sharing these principles to help others. Early in my career, I started investing in real estate and then the markets. But when I took about a 90% pay cut to leave the corporate world and focus on building what became my largest business, my wife and I were also in the process of adopting our daughter, Hannah. And I was determined not to have to finance her, quote unquote, through going into debt, taking a home equity line, that sort of thing. So I took principles that I learned investing in real estate and I transferred them to trading the markets. And my goal was to create consistent income to help fund our adoption while working 80 hours a week building my business. The 12-minute trading strategies were the result, and I'll talk about this more in a few. I built a number of businesses over the years, including 12-minute trading, the Misfit Entrepreneur, real estate and business holding companies, larger software companies that have been on the Inc. 5000 and Entrepreneur 360 list 6 times. And I was fortunate to sell some of them and semi-retire, spending more time with family and focusing on one of my passions, Ironman racing. But probably my biggest passion has always been building wealth through investing and trading the markets and helping others to enrich their financial lives by teaching them how to have a trading business that produces professional trader-like income without professional trader-like time. And that's what we do here at 12-Minute Trading. All right, I'm going to turn it over to Doc to tell you a little bit more about himself and his background.
You may or may not have heard of me before. Again, my name is Doc Severson. I'm an individual trader, performance coach since 2005. 2005 was when I turned in my notice. I was working at a large 3-letter acronym telecommunications company, making 6 figures. And so people thought I was nuts to quit that and to trade for myself. But I had to. It was a case of inspiration and desperation, right? Desperation to get out of the cubicle farm and to get out of the 9 to 5 and commuting 80 miles a day. And it was just, with 3 young kids, I just was missing their childhood. And then what happened with the coaching thing is that after people found out that I had quit my job and was trading for a living, they started knocking on my door and saying, "Hey, could you help me do the same thing?" So what I found was it made me a much better trader helping other people because it forced me to really, show accountability and get my act together and run just in front of them. So you may have heard of me before at different services like Options Linebacker, Options MD, Theo Trade, Docs Trading Tools, Ready Set Trade along the way. And then I hooked up with Dave yet again. So Dave and I first worked together. I think it was like 2007 or 2008 or something like that, long time ago. And then we drifted apart. And we met back again. It was almost like we met back in the fork in the road last year, and it's been a lot of fun to work with Dave again. My specialties are fractal price analysis, options, and future strategies. And then because of the fact that I've got this lizard brain like everybody else does, I had to learn how to fix my own trading mindset. And so this is why I wrote the book Hacking the Holy Grail, which is available on Amazon. And then the Fractal Energy Trading book came out a couple of years ago as well, too. So if you're interested in learning how to read price action and understand how to use multiple time frames to improve the accuracy of your trades, that will help you a lot. And again, both of those available at Amazon. My job really is to take the complex and try to simplify it as much as possible. So with that, Dave, that's me. Back to you.
Thanks, Doc. And I think I got the mic situation kind of taken care of. It was like jumping back and forth for some reason. Zoom was being a little bit buggy. So you guys should be hearing me better now and everything. When I first started investing in markets, I think, Doc, your story is very similar. I was just like everybody else. I bought stocks and then eventually learned about options and started buying those. And I bet you can guess what my results were. They weren't great, right? I would win some, then I would give it back, and I basically would go nowhere. And it was at this time that I had this really big epiphany, this really big realization, and it was this. If you buy a stock or an option, how do you make money? It's not a trick question, right? It has to go up, right? And in the case of an option, you needed to go in the direction that you bought it for, right, to get the profit. But the problem is a stock can really go three ways. It can go up, down, or it can stay the same. So if you do the math, just buying a stock or an option gives you a 33% chance of winning, right? When I realized this, it was a huge epiphany for me. And really to put that in perspective, the odds of winning a hand in a blackjack hand at a casino are 46.36%. You're literally better off taking your money to the casino versus buying a stock or an option if you've got no strategy, no edge, or any of that type of stuff, which is what a lot of retail investors are doing, right? Tell me if this sounds, familiar, okay? If you're new to this, your first time with us, or maybe for those of you that have been with me for a while, think back, right? Before you found 12-minute trading or found a strategy that actually, was consistently working for you. Do these things sound familiar? You tried several programs, maybe a lot of programs, gurus out there. You haven't had a ton of success. You're sick of bouncing from one place to another for what actually works. There has to be an easier, better way. And you just want to have a clear path to winning and profiting consistently in the markets. Here's the thing to understand. It's not you. It's the fact that when you buy a stock or an option, the odds are stacked against you from the very beginning. Most of the programs, the gurus, the industry in general are just teaching buying strategies, and that's really hard because in order to win, you have to be right. And you have to be right a high percentage of the time. In fact, most of the time, they are guessing and hoping to be right. And hope isn't a strategy for anything. I think we've all seen the jokes about, hey, whatever Jim Cramer says to buy, just do the opposite, right? Because buying is hard. So sure, guys like Cramer and a lot of others are good at the hype and excitement, but that doesn't necessarily translate to profits. And so real traders know how to find and maximize an edge. And that's really what we do at 12-minute trading. When I realized that you have a 33% chance of making money in buying, the first thing I thought was, well, who has the 67% chance? Because that's who I want to be. I only sell options because by just choosing to sell options, we put the odds in my favor of 67%. And then I learned that I could increase those odds to over 90% through how I enter and manage trades, including using my proprietary indicators, time-tested rules. Doc has his as well. But we really effectively become the house selling to the suckers in the casino. And it can be done in 10 to 12 minutes a day. And as a result, Doc and I have proven that these strategies can and do win over 90% of the time, even in bear markets. And that's the power of selling options, because you don't have to be right. You don't have to call a direction and hope for it to work out. You can make money really most of the time, no matter what the market does and no matter which way a stock or an index goes. But there is one caveat. I would say, and Doc, I think you'd agree with this. We're not home run guys. We don't design strategies for these big 1,000% home run wins. We design them more like an insurance company, right? For consistent base hit wins, collect that premium month in and month out, and it adds up over time, over and over again to be bigger than the home runs. That's why insurance companies are the richest companies in the world. And besides, as many of you know or have experienced, most traders that go after the home run profits, give those back on the next few losing trades and anything. So I know for many of you, sharing all of this is probably nothing new, but for a few of you out there who haven't been exposed to selling options, or it's been a while, I hope kind of me going through this, reviewing this a little bit, opens your eyes to the fact that you can create consistent income in the markets. You don't need to have some magic ball to do it. And you don't need to spend hours on it either. You just need to put the odds in your favor, and you can do that in just a few minutes a day. And so hopefully you can see the power of trading the markets this way. All right, let's discuss the top 3 lessons learned so far in 2023. So lesson number 1, navigating market character transition is tough. This year has given us a great example to learn from. Markets change character in the normal course of a trading year. They go from uptrends to pullbacks. We're in a pullback right now, and sideways and so on. But those are typically in contrast to a bigger overall trend. So for example, a multi-year bull market will have periods of trend followed by pullbacks and even sideways periods, but it's still chugging higher being a bull. And bear markets are periods of high volatility that have large downward moves populated with relief rallies until they finally bottom. One of the toughest periods in trading markets is when you have shifts between those bigger overall trends, such as a multi-year bull into a bear and like a 15-month bear back into a bull. And this year has been a great example of that larger trend change from a bear to a bull. And while it really started last October was really the bottom, it didn't kick into big gear until really around May. And those changes can be tough on traders. Why? Because almost overnight, what was working well in a bear stops working, and vice versa. In my case, I knew going into the spring that market character was changing, but the volatility was still somewhat present. So trades like my target 100 weekly iron condors and others were working. But then after a decent rally, we got into a sideways pattern for about 6 weeks where we just went nowhere. The strategies continued to work well, and we knew that we would get a big move out of that sideways action. But not even I could predict the parabolic upside that came out of it, along with the corresponding volatility crush. Almost overnight, it became harder to sell target 100 trades, and I had to pivot away from them. Additionally, because of the rapidness of the higher move, I had a few trades that got caught and attacked. I was able to manage, and in the end, had 3 to 4 that I had to take a little bit of a loss on or roll out. But that's what happens when you go through that market character change. And the lesson that I'm taking from it is that I personally need to do a better job of understanding the current market character and potential transitions. And for example, during the sideways period, I could have changed some of my back to some of my old bull type strategies sooner. Losing for me, is very, very rare. So even when I have one loss, I do a lot of analyzation of it to see what I can do better and win in the future. And one of the people I turn to, who's one of the best at this that, I need to continue to learn from, is Doc. And so I've asked him to do a quick overview of the 4 types of market character and how they change so that you can get better at spotting them for your needs. So Doc, I'm going to turn it over to you. You should be able to share your screen.
Okay, so tell me if you can see the main header slide here.
Yes, we can.
Okay, super. All right, so I'm going to run through this really quickly. So first of all, being an engineer, I'm going to start with a problem statement. First of all, many of us trade the market that we wish that we had or the market that we're comfortable with instead of the one that we currently have. But like Dave was saying, markets change their stripes constantly. Retail traders learn a strategy or an approach to the markets that tends to work sometimes, but not at all, during other times, and they don't know why it fails when it does. So if you spend any time on social media trading accounts, you see these waves where certain people will talk about a certain specific strategy and everybody jumps on it, dog piles onto this strategy, and then all of a sudden it stops working, and then they go thundering, off to the next strategy. So my purpose today is to show you the why and how aligning your approach to the markets based on what the character of the market is showing us. This comes from a book that I read a long time ago from Bill Williams, Want What the Market Wants. So don't be stubborn about insisting that the market act the way that you think it should. Want what the market wants. So how do we do this? By figuring out how it's currently behaving and what strategies give us better odds in that environment. And also by understanding the next likely transition that could occur. And I think this is really, really key. Okay, so the market seasons. The market does go through seasons here. There's 4 phases to a market cycle. You may have heard of this before. The market will go through disgust to disbelief, because people can't believe that it's rallying. And then finally they accept it, that it is rallying. And then pretty soon they go into euphoria where they think that they'll never again see a red candle. And then that's usually followed pretty quickly by disgust again. So this happens whether it's intraday, over the course of a week, over the course of a month, or maybe even years. I see this 4 phases to a market cycle constantly. But what I want you to do is I want you to look at how the different sections of this market, so this one went from 2016 up to early 2023. And notice how these sections are all different. This is what we're talking about with market character. It's got a different inflection to it. It's got different volume and different movement, different volatility. And it's just each one of these is just a completely different trading experience. So if you've been around for a number of years, you've seen every single one of these, and each one of these requires something different. Okay, so these 4 distinct market characters, the rest of this material was from a book called The Way of the Turtle, if you're curious about this. So there is, that's my source for this stuff. So here's a matrix that I put together because I used to work with vendors like GE and stuff like that. They were able to put everything into a 2x2 matrix. So I thought I'd do the same thing. If we're looking at the dimensions of trend and volatility, trend on the vertical, volatility on the horizontal, we have a trend being either sideways or trending. So, trending being more of a trend than sideways is. And then obviously volatility is either quiet to volatile or somewhere in between. So if we put these together, we're going to have market characters like quiet and sideways, quiet and trending, volatile and sideways, and then volatile and trending. This is really mostly what we see. And I would further refine this to say most of the time we are going to see quiet and trending. The market has a positive drift. And then when we get into corrective behavior, we will see volatile and sideways. So those are what we're going to see most of the time. And that's all I'm going to talk about tonight. So I'm going to kind of attenuate this. Usually this is probably about an hour that I'm going to cram into about 10 minutes here. So quiet and trending. This is what a quiet and trending market looks like. This is, by the way, 2017, which was an outstanding example of that with a great parabolic finish to it at the beginning of 2018, and then it started all over again. This character dominates. This has been the most prevalent over time. There's a natural positive drift that naturally take hold and enforce this type of character through the majority of time. So we need to be good at it when it shows, right? We need to really rock and roll on this thing when it shows. So some of the characteristics to identify quiet trending: it's going to be an uptrend, first of all. It's going to be choppy in the middle with a parabolic tail. So I'm going to try to draw this. I don't know if this is going to come through or not, but I'll give it a try because I think this will help. Typically what we see is something strong off the bottom and then gets really choppy in the middle and then goes up to a parabolic tail. So hopefully that will come through. range expansion to range contraction repetition. So range expansion trending goes into consolidation, and then we'll go into trend again. We see this stair-stepping type of behavior all the time. Pullbacks are quiet. They're methodical. If you look at the pullback that we've been in for the last week, it's very quiet. It's very methodical. It's not screaming lower. It's not dropping hundreds of points every single day. It's very structured, very methodical. This is exactly what we're talking about here. The market climbs the wall of worry. The market's job right now during a quiet and trending bull market is to convince you that it's over constantly. So constantly you're throwing your hand in and saying, well, that's it. This has got to be the top. And then boom, off it goes again. This is called the wall of worry. The more hated the rally, the better off it does. Very low implied volatility with excitement on the first red candle. Every time somebody sees a red candle, that's it. Here comes the next bear market. You're seeing tweets all over the place, or whatever they're called these days, about how the next bear market has begun. I see it all the time, right? Option sellers don't see much room. There's not much volatility. So you got to be used to a little bit more of this CQB, or close quarters battle. It ends in a runaway market with low information traders leading the market at the very top. So we see quiet and trending the majority of the time, or at least to this point in history. So this is the time to be as long as possible. This is why I call it a musical chairs market. As long as the music's playing, you want to be as long as you can, right? So as long as it's playing, don't worry about getting a seat. Just get as long as you can. At the very end of the move is when it's obvious. By then, you should be getting more defensive and not dogpiling. So some of the strategies that you can use for this. And I'll go through these very, very quickly here. So long delta, which means they make money as the price goes higher. Covered calls, long diagonals. Iron condors can work, but you're going to have to go out several months in time. Put spreads will be a problem on pullbacks. Call spreads will be under continual pressure. Overall long delta portfolio. So if you have a stock portfolio, this is going to help smooth things out for you. Time spreads, which are like calendars or diagonals, might be necessary to employ during very low periods of IV. Maybe even 0 days to expiration positions if you're looking for income augmentation. Use the linear nature of the price movement to employ pullback and breakout swing trades on selected underlines. Okay, the time to play defense is during times of peace, not war. So don't worry about hedging these things when it's already dropped several hundred points off the top. You got to do it when things are quiet. Understand right now that it's impossible to spot the very top of a market move. So prepare yourself for chaos. It's very difficult to do when the markets are flying. Downside insurance is also going to be relatively inexpensive. So laddering into short delta or long Vega instruments over time is a wise move. Okay, let's talk about the other one really quickly here, volatile and sideways. So markets go from bull markets into volatile and sideways, and this is where they get really, really noisy. Volatile and sideways character. This is exactly what they, notice the transition here. Quiet, 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 low volatility, huge volatility. Quiet, quiet, huge volatility, sideways. So it enters via an uptrend always. Starts with a shot over the bow, a big red candle. I mean, these are usually really, really big candles, not 20 points on the S&Ps. Realized volatility is orders of magnitude larger than quiet and trending. The VIX will normally spike on an initial move down and surprise. Much higher implied volatility to start eventually will normalize. The majority of this time, the character is the launching point for the next quiet and trending move. So what I'm saying here is that get quiet and trending, goes sideways and volatile for a while, and eventually will launch into the next bull market. Will occasionally be the gateway transition to a full bear. We're not going to focus on that. So it's a shock to the system if you can anticipate this if you're preparing for the moment. So some of the strategies, I do not advocate the opposite of quiet and trending or a short delta portfolio. You're never going to be able to time this at all. You're going to see stories of bears like Michael Burry and how they made billions during periods like this, but you have to be way, way early. You got to be in it to win it. You got to be super committed. So never chase a move lower. So if you see a move which is topped out and is already starting to go lower, you're too late. You cannot get into it at that time. My approach during this character is to assume that it's going to be a correction, which may take a few months to work out. So if it deepens into a bear, we're going to know it later. Play the swings up and down. Clear your trash on the bounce back up. So if you're convinced that this is it, so get rid of your long portfolio on the bounce back up. And you'll see if you study these things, you'll always get that chance. Get ready for the next plunge when it seems like the coast is clear. So I like long iron condors, out of the money debit spreads. Out of the money calendar spreads can be used, but they're tough. You can sell puts or use what I call modified long synthetics on deep sell-offs. Play the bounce back to the upside. So you got some big swings that you can play. This is basically what a modified long synthetic is. You can design a trade, which basically you've got a huge amount of area here where you can't be wrong. You can't lose any money, and you still have upside to play if the swing extends itself. Okay, so make sure you lay out a price or technical achievement that will signal that the volatile sideways character is potentially transitioning back to quiet and trending. Okay, so this is typically through price levels, but you have to prepare for the converse to occur, which is the transition into a full bear. So I will take questions at the end of tonight's session if there's anything that's on here. If I've confused anybody, if you're not sure what the terminology means, let me know and I'll be sure to clear it up. So we're going to go back to Dave now.
Thanks, Doc. I'm going to jump back in and we're going to go with lesson number 2. So we just covered lesson number 1. Understanding market character is really important. I think this is a lesson that really is a lifetime lesson for trading as an investor. Lesson number 2, though, is trading this market longer term is the best way to trade for high probability, right? So Doc kind of just alluded to that. We're into a quiet and trending. We may be in a little corrective pattern right now from that quiet and trending, but we'll probably be back to quiet and trending, relatively soon, right? It's amazing, though, what a year can do, because last year in this same event, lesson number 2 was all about trading short term in the bear market, taking advantage of that high volatility. Now we're in a complete 180 situation from last year where we have very little to no volatility, and trading short term is much more difficult and frankly not worth the risk, especially when it comes to high probability trading. As my students have noticed, what I've done over the last couple of months is dust off the old bull market playbook, selling further out, beginning to sell only put side trades, and things like my double trades still work. They've continued to be pretty profitable, but selling 3 to 6 months out when it comes to high probability, giving that room right below key levels is really the sweet spot in a type of quiet and trending market. If you're really looking for kind of that set it and forget it, spend just a few minutes a day on things. So I've shifted those type of trades now, adding those back in. And the nice thing trading this way is, like I said, it just doesn't require a lot of maintenance. It just you got to let time work on these things. And, that's the way that really made me successful over many years, because we were in a quiet and trending market for all those years, right after 2008 and even leading up to it, because you truly can trade in just 12 minutes a day. So Doc's been approaching it from a little different angle. Doc, you want to talk to him about solving the problem using the low volatility or the low probability trades? Go ahead.
Well, what we found was when we have markets that are dropping in volatility like this and increasing in linearity, what we found is that with some of the high probability trades where we were selling an excess of implied volatility, and so the risk premium was really rich, and it was great because we were getting huge distance. And now all of a sudden that edge has changed because the market character changed. And so we had to change our strategy as well too in the daily target 100. We went into what I call a low probability trade. Now, it's not a negative thing. A low probability just means the probability of success might be lower to begin with. So instead of going a mile out of the money, you're playing much closer, but there is some huge advantages to doing so. Faster decay, there's lower risk on the trade. So I don't have to worry about any kind of black swan risk. I don't have to wake up in the 2 o'clock in the morning and check the futures to make sure my position's not in trouble. So lower overnight or gap risk, protection against black swans, and entry requires more precision to find temporary consolidation conditions. So it does put a little bit more onus on me to do that, but it's also a much, much better trade for smaller accounts because it uses way less margin, way less risk, and it's really a much better strategy for today's low volatility, quiet and trending market.
Perfect. All right. Lesson number 3. Every moment in the market is unique. I've said this many times before, and I think the changeover from the bear to a bull really crystallized it. Traders get stuck in the past and they want to continue trading things that worked when the market was in one character. But the lesson is to really always be looking to the future and not ignore the market in the current time. It's hard because it's not supposed to do that, right? It can't keep going in that direction. This is crazy, right? I think probably some people have said that over the last few months, right? But I'm sure, you're understanding that you're just going through this transition period, right? And that's the lesson. Markets will act irrationally at times. And the best thing you can do is not try and fight it, but look at how you can take advantage of it in the short and the long run. Remember, price is king. And if a market wants to run a direction, it can go a lot longer and much further than anyone thinks it should. Then it will go back the other way. This has been a great example, and we may be seeing it back the other way now. I've said many, many times, markets will run as far as they can in one direction, then turn and run as far as they can in the other, right? So the last few months' move upward has really been a perfect example of running as far as it can in one direction, where the pullback never comes, and then all of a sudden it starts, and it takes like an event that comes out of nowhere, like we've seen, right? Like downgrading the U.S. debt. And there you go, right? And so it gives it that excuse. And so the market's going a lot longer than people think in either direction. Docs, your thoughts on this lesson?
Well, I think what we also do is that we've got a memory. One of the things about every moment in the market is unique is that I see a lot of people doing, a lot of us are parents, right? We've had kids and we identify human behavior. And so when you see your child acting in a certain way, you know exactly how this is going to happen. And you step in and you play mom or dad because you know what's about to happen next. You're using your wisdom and your experience to prevent a disaster. But the problem is that the market, unfortunately, is worse than a child. It does not act in a predictable manner. And so a lot of people got hurt last year because there was a huge meme going around social media going, wow, look at this market A versus B comparison where we see this is exactly what happened in 2008. So hold on to your butts, folks. Here we go. We're about to plunge 1,000 points on the S&P. And that was right around March. And what happened instead was we rallied 800 points to the upside. Right. So when everybody's making these comparison things, they're forgetting about this lesson that every moment in the market is unique. Now, there's a difference where you can identify kind of different characteristics of behavior, which is what I just talked about at length a few minutes ago. But that's different from predicting the future. So understand, give the market don't box it into a corner, because what you'll find is more often than not, you're going back in time and you're forcing the market to act in a certain manner, and that rarely works.
All right, we have a bonus one for you. And that is markets will climb the wall of worry. The credit for this bonus goes to Doc. He just mentioned a second ago when he's going through the character. So Doc, go ahead and elaborate. Markets climb the wall of worry.
Market's job is to separate the greatest amount of cash from the largest cross-section of traders that are out there. I mean, there's so many ways. I mean, the market is Machiavellian in its ability to do that. And the only reason, it's not that there's some guy behind the green curtain, paying attention pay no attention to the man behind the curtain kind of thing. It's not that it's an evil market maker. What's happening is it's a collection of literally millions of people acting in their, in their own best, behavior, right? So they're acting to benefit from themselves, but they're doing things against themselves that gets them into trouble. So in other words, like, for example, if you have got a bearish position and you want to, perhaps hedge a little bit by adding a long stock position. Well, you do that as well as 5 million of your closest friends. And next thing you know, all these extra long stock positions end up pushing the price even higher, those kind of things. So markets will have this very unique way of creating things. And we're seeing it this week, right? We're seeing it last week with Fitch. We're seeing it this week with Moody's. Everybody's like, well, that's it. We're ready to go back into the bear market again. And this is the market's job, is this continual sense of insecurity and fear that is always, so markets climb this wall of worry. And chances are by the time that we're talking at the end of the year, price will probably be higher because of all this fear that's out there. So that's how the markets climb the wall of worry.
Thanks, Doc. We have some other takeaways too for you guys. The first one is it's still better to play indexes versus individual stocks due to risk events, earnings, and guidance. We're still seeing stocks get really, really punished. I think that will change as we get more into the bull, but we're still seeing stocks get really punished on, just a little sideways on earnings or a little bit of, guidance that doesn't fit with what the market wants, right? So, even even a great stock, can tank in this environment. And so indexes just seem to be easier. Now, an exception to that is oil. Oil's an exception. Oil stocks, have really been in a bear market, up until probably more recently. We started in June talking about this in our mastermind group about maybe this oil was ready to come out and move to a more of a back into more of a bull market, and it's been up almost 20% since then. So it's moving into that. Stocks in the energy sector are going to be good for trading, and I've been doing that as well, and putting plays in on that. So I think that's an exception. We're most likely headed for a recession in 2024. Macro trends continue to slow. I think housing is finally starting to really drop. I think that's going to be exacerbated a little bit as things go on, and so that's something to be aware of. And then make sure you have an outlet. I think this is most important. Make sure that you have an outlet to get away from the markets. Mine's spending time with family, doing fun activities, training for Ironman, things like that. Personally, I cannot sit in front of a chart screen all day and watch the markets, right? It just drives me insane. So we got to take breaks from it and enrich our lives so that you make sure that you have focused time, for those things in our lives. So get an outlet. And best advice going for the rest of 2023, from me, it's adjust for the current and the future and don't hold on to the past. I think we beat that to death at this point. We've got tremendous opportunity to take advantage of the new bull market, though this one may run into a recession at some point here in the next, year or so. But I think for the next 6 to 9 months, there's a lot of wealth that can be generated by adjusting to it, especially selling into the pullbacks like we see now as it grinds higher. And from Doc's standpoint, learn how to read price action, replacing news and bias with a focus on price. Doc, you want to elaborate on that a little bit?
Yeah, sure. I think we all come to investing thinking that, we start listening to Jim Cramer, and, we start following other people, and they make predictions, and then we sort of follow along with that. And then what I've seen a lot of younger people do is that they fall into things like subreddits and forums or Discord areas where they're following a person, right? So what I want you guys to do is to get away from that sort of thing, because following a person or a guru is not going to help you over time. And it's going to give you a bias because you're going to adopt whatever views that person or that thing thinks of in terms of the future. And again, like what we said, it's really, really hard to predict the future. I don't know what's going to happen in the next 5 minutes, let alone next week. So Price action is the way to understand that. If you just look at a chart and say, what is the chart telling me? What is the trend at the monthly chart? What's the trend at the weekly, daily, 78, whatever mark, and amalgamate those together and understand how the puzzle pieces fit together. That is where all of a sudden you can start to relax and say, well, here's my read on the market. This is going, the current trend right now says that it's going higher, or we have a short-term pullback here. This is how the puzzle pieces fit together. So you can replace that instead of, this sense of, hey, what's going to happen next? And this is what I find with a lot of people that are following a person. They get hooked on that person telling them what the future is, and instead learn to read charts.
Excellent, Doc. And that's really, I think one of the most important pieces of advice for a trading career, right? You got to tune out that noise, and really price is king in the end. All right. So now that we've gone through the lessons, I think one of the things that is very important, we live in the moment as traders, right? We're looking, at things on a weekly basis, maybe a monthly basis, a few months out, really, as traders. We don't look at things in 5-10 years out and how you prepare for that. And part of that's because we're making money now and that sort of thing, right? But there are bigger things that are at play. And it's always really good to take a step back and really kind of look at, all right, what is the bigger overall future hold, and how do I prepare for that? And that's where I want to shift gears. And I want to go in depth on the reality of our financial system, our money, and help you understand what is really truly coming in the future at a longer term scale. Mastermind members know, people that know me know, I love history in the macro sense and looking at the way that economies and markets have worked and that sort of thing over the years. And I've done a lot of extensive work on this. And I think this is going to open your eyes in a somewhat sobering way, but it's also going to crystallize some things for you. I want you to keep in mind, though, as I go through this, no matter what happens in the future, there is always opportunity to succeed and build true wealth. And that's why I study these things, because I look at what people have done in times of true turmoil before to build and gain wealth. And we're going to give you some of those things to consider in building your wealth in the future in the context of what I'm about to share with you as we go through this. As a quick note, too, the following is taken from some of the work that we've done to maximize our wealth and stay ahead of the changes happening across the world and coming in the future through the 12-Minute Trading Mastermind. And I want to thank the group for giving them the blessing to share this with everyone, because this was originally created specifically for them. And so I've purposely actually made this more word heavy on some slides, because you're going to want to come back and refer to this presentation. You're going to want to use it. And I'm not going to read the slides verbatim. I'm going to skip through some and stuff. So don't worry, though, if you don't get everything. Just sit back, relax as I take you through this. And when I'm done with this section, pay really close attention and stay tuned, because we're going to cover a lot of ground. But we've got some very big special announcements and service improvements for you, as well as answering your questions. And you'll probably have some questions with what I'm about to share as well. So this is called Economic History, Changing World Orders and the Monetary System. Where are things going? And I'm going to start with a quote. And I want you to keep this in the back of your mind as I go. Okay. Ernest Hemingway, in his book, The Sun Also Rises, the question was asked, how did you go bankrupt? He said 2 ways: gradually, then suddenly. And I just want you to keep that in the back of your mind as we go through this. To understand what's coming at you, you have to understand what has come before you. So there are a few important dates in economic history specifically for the U.S. 1913, 1944, and 1971. Some of you may know what those dates symbolize, but if you don't, I'm going to give you a little bit of background. You come back and read some of this later. But in 1910, a secret meeting was held on Jekyll Island. It was and it had basically the kingpins of the banks throughout the world represented. And the result was the Fed. It was a meeting to design the framework for the Federal Reserve, and that eventually was signed into law in 1913. Now, I think it's really important to understand that there is nothing federal at all about the Fed. It's a cartel of the largest banks. That's what it is. And actually, it's the third central bank in US history. The other two before it failed. The creation of the Fed created the fractional reserve banking system that we have today, which is a debt-based system, which is very important as I go through some of these things today. In fact, and this is an eye-opening thing for a lot of people, they don't realize it, all money that exists is debt. So if all debts that were out there were paid back, there would actually be no money in circulation. Nobody would have any money to spend on anything. So I'll let that sink in for a second. All money is debt. All right. So that's 1913. 1944 was the Bretton Woods Agreement. This established the dollar as the reserve currency of the world and pegged it to gold, basically $35 to 1 ounce of gold. That's what it pegged it as. Okay. So this was critical because after World War II, right, the world, at least Europe and some of the areas in Asia were in shambles, and the U.S. was kind of the king maker, right? So we got to take over, and we got to become the reserve currency of the world and the world monetary system. In 1971, Nixon took us off that standard. Now he took us off that standard because we were starting to print money and use it for fighting the Vietnam War, and so we had to basically depeg from gold because we were starting to violate the Bretton Woods Agreement, right? And even countries were actually starting to call us out. So Nixon came out, depegged the dollar from gold, actually added some penalties and stuff around it and everything. And what that did is allowed the dollar to float, and it became true fiat. In fact, the next day after that happened, the stock market went up 10%. You would think it would have gone down, but what it did is it kicked off inflation. And it floated like that for a few years until 1973, 1974, where Kissinger went over to Saudi Arabia and basically made a deal that the United States would protect Saudi Arabia as long as they priced their oil in dollars, basically OPEC pricing their oil in dollars. That's an important thing that we're going to get to in a little bit. If you've never had the chance to go to, there's a website, it's called WTFhappenedin1971.com. Okay, so that's the literal name of the website, WTFhappenedin1971.com. It shows what has happened ever since we came off the gold standard in 1971 when it comes to your money and your purchasing power and everything else. And so it's very long. There's like probably 100 charts on that website. I just pulled a few of them that I think are very pertinent. This is the cumulative inflation since 1971. We're up over 2,300%. At the same time, there's been a relentless 50-year decline in wages as a share of total income. So inflation is continued to erode at the dollar. And you guys hear me, if you watch our live sessions, I'll talk about how inflation's insidious and how the Fed targeting 2% inflation is actually still evil because over 10 years, it compounds and it's a massive amount of buying power loss. Well, this is what these charts show, right? And home value changes, right? So this is home value changes versus income changes. And so what you're seeing is incomes are not rising enough to keep up with the home value changes. Now, it's not that homes are going higher, right? It's that the dollar is losing its value. And this is why the stock market has a positive drift over time. Assets will have a positive drift. Physical assets, which we'll talk about here in a little bit, will continue to gain in value over the course of time because the dollar continues to lose its value over the course of time. This is the parabolic rise in the debt ceiling that we have had to do and continuously raise the debt ceiling to be able to keep up with the dollar essentially losing its value, right? And we've all seen charts like this before, right? How do they usually end? Not that great, right? And that brings me to the topic of changing world orders. Now, I'm not talking about the emperor and the New World Order and all that type of stuff. I'm actually talking about the history and the rise and fall of empires, right? And what is a world order? A world order is actually the governing system for how countries deal with each other. Many times they're laid out in treaties, trade agreements, right? And these orders tend to change after wars, internal and external. So after the war, 1944, Bretton Woods, the new order became the United States, right? Was the new, king, right? The new country in charge from an order standpoint. And a lot of what I'm going to share with you comes from Ray Dalio's book, The Changing World Order, Why Nations Succeed and Fail. This is a fantastic book. Ray Dalio, if you don't know him, is probably there's probably argument as to whether he is the number one hedge fund manager of all time. I put him up there. I think he's a very, very smart individual. And so the current world order, commonly known as the American World Order, started after World War II, was set out in the Paris Peace Treaties, the Potsdam Conference, and then Bretton Woods. And throughout history, the country whose currency became the reserve currency was the dominant country. But throughout history, dominant countries and systems of the order rise and fall. And it's happened with the empires of the Dutch, the British, Spanish, and you can see on and on, throughout the centuries if you go back and look. The four big ones are the Dutch, the British, the Chinese, and the US. And the empires of dominance of the world typically last around 250 years or so, with periods of 10 to 20 years between them. And the transitions really have been periods of a lot of conflict leading, powers don't decline without a fight, right? And so you have a lot of conflict during those times. And usually there's wars and stuff. And then when it's over, right, that's when you get into peace because everybody's done fighting the war, new order is put into place, and, it's relative peacetime. That's how it works. And so the cycle has three phases: the rise, the top, the decline, and the cycle starts after a major conflict, like I just said, war, right? And then you have that period of peace. Ray actually does a phenomenal, amazing video on this where he narrates it and everything. It's about 45 minutes long. We're not going to show it, but I put the link in here for you when you get this presentation so you can go back and watch it. And I highly recommend that you do. And it's just, it's very eye-opening, and it really explains it very, very well. In fact, a child could watch it and understand it, which is really, really neat. So he really talks about the big cycle, the rise and fall, what it looks like. It's great to watch. Here's a hint. In the video, the U.S. is on the downward slope after the rise, the third phase, the decline. And so that brings me to our next topic, crossing the Rubicon. Now that we understand some history and the cycles of changing world order, I want to talk a little bit about what it means to cross the Rubicon. A lot of you have heard this before. Not everybody knows where it came from. It actually comes from history in Roman times, where when a general's done fighting a war, the northern part of Italy, there was a river called the Rubicon. And the rules of Rome said that the army was to be disbanded at the Rubicon and not cross the Rubicon, because they didn't want the army crossing the Rubicon, essentially doing a coup and taking over, right? Well, who did that? Caesar is the one that crossed the Rubicon. Caesar actually took his army across the Rubicon and ended up becoming the emperor of Rome. And when he did it, he knew there was no going back. He was past the point of return. And that's what it really means to cross the Rubicon. The U.S. financially has crossed that Rubicon. And so that Rubicon is the U.S. debt levels. Now, a lot of people don't know this, but every year the government actually puts out a financial report. It's called the Financial Report of the United States Government. It came out on February 16th of this year. And I put the link in here. You can see it on the screen, so that if you want to go get some light reading, you're welcome to do so. But don't worry, I've actually gone through it for you. And here are some highlights, or maybe lowlights, depending on how you look at it. When a politician tells you that the FY22 deficit decreased 1.4 trillion, which has been a talking point, it's a lie. The financial statements really show reality. In fact, on page 7, they state our current fiscal path is unsustainable. On page 17, they talk about two metrics for how they measure their budget deficit. The first is cash basis, and that allows you to massage numbers and move things around. Anybody who's owned a business knows there's cash and there's what's called accrual basis. Most business do things on accrual, but cash, you can kind of play with the numbers a little bit. It's cash in, cash out at the time. But delaying a big expense, that type of stuff can happen. The rest of the world, right, is on accrual, and that's the standard for true accounting, recognizing income and expenses when occurred. In the report, the U.S. government follows the same rules, and they call it net operating cost. Okay. So the government actually calls it that. And that's right there. This is a chart right from their, from their document. And it shows that actually the real deficit in 2022 was negative 4.1 trillion. The year before it was negative 3.1 trillion. So the deficit actually increased by 1 trillion year over year. These are their numbers. The government also has a balance sheet. The net worth of the government is minus 34 trillion for fiscal 2022. In 2021, it was negative 29 trillion. So it's gone down or gotten worse by 5 trillion in just a year. But wait, there's even more. Social Security and Medicare funding gap, negative $75.9 trillion. Now, guys, I want to put something in perspective. The universe that we live in has been around 13 billion years. The Earth has been around 5.4-ish billion years. That is a pimple on the butt of the elephant of this craziness of these numbers. And these aren't numbers you hear, right? You don't hear about that. You just hear about the national debt. We're already over $100 trillion just from their own report. Now, here's where it gets even more interesting. In their own report, they say in the next 50 years, the debt held by the public is going to go up 500% of GDP. This is their chart. And the CBO just this last week came out and has said and projects that the U.S. debt is going to go up $5.2 billion per day for the next 10 years. And the CBO, guys, is usually not right. It's usually worse. So that's what they're telling us. That's what's actually in their own numbers, their own report. Even more maddening, if you will, is the government actually failed its audit. Now, I'm not going to read this whole thing from page 43 about the weaknesses and all that, but there's one line in there I think is really important. Material weaknesses resulted in ineffective internal control over financial reporting for the fiscal year 2022. So all these agencies, all these offices, there's no fiscal control mechanism really going on that the outside auditors can actually validate even this stuff to say that, yeah, it's not worse. If that was a corporation, guys, they would be in jail. The CEO, the board, they'd be in jail. So what about Social Security? From the Social Security report, trust fund exhaustion is currently projected to occur 2037, means a precipitous drop in the level of benefits that can be paid. Many predict that it's going to be much sooner, as Medicare is actually projected to run out of money later in this decade. So, okay, we get all this, right? We hear this and we just shake our heads. What's the answer, right? Right? If you're shaking your head at this point, I can't blame you. But defaulting on the debt and or the obligations is most likely a possibility. Printing money, inflation, that's a stealth way to default. Remember, if you get inflation up enough, you're paying back this debt with a lot cheaper dollars, right? That's why the Fed secretly loves inflation. That's why the government does. So higher taxes. The only way out would be to get fiscally responsible, shrink the government considerably, free up the private sector with lower taxes and better economic policy. And a great example of this you can go back and read about was done in the 1800s by Britain. They actually brought their economy back from the brink for about a 50-year period that is considered the British Golden Age. If you want to kind of really look at a country getting its act together and actually doing the right things to make it the most prosperous it can be, that's an amazing thing to read about if you're into that sort of thing. But like I said, if you're shaking your head at this point, I can't blame you. But remember what I said when we started. No matter what happens, there's always opportunity. Some of the largest companies of today were created during the Great Depression. Others during the 1970s and 80s when inflation was much higher and interest rates were 18%. And we're going to share how to better prepare and take advantage. But first, I've got some more to discuss with you guys. So the question really becomes is like, where do you think this ends up over the next 10 years, right? It's best to start preparing now for the impact of the U.S. debt spiral, higher taxes, more money printing, continued inflation. We're up 2,300% almost. That's the path. And we're continuing. And then, Social Security and Medicare benefits changing or decreasing. I'm 42 years old. I may not actually see much from Social Security and Medicare. I have to plan for that personally, right? In 2037, I won't even be there yet when it's predicted to go out of. That's stuff we have to think about. And I think a bigger thing that we have to think about too is that what would happen, right, if the US dollar, reserve currency is the key to everything, right? We talked about that, and we talk about world order, reserve currency is the key to everything. So it's time to go down that rabbit hole a little bit. And what makes the dollar the reserve currency? Well, oil. It's the petrodollar, right? OPEC prices sells in dollars because of that 1973 deal. And essentially what we did is we got off gold standard, went on the oil standard, which was probably better because energy is the lifeblood of everything, right? And so we traded one commodity for another, but it's remained that way. And the US has remained the reserve currency because everybody has to own dollars to be able to buy their energy and buy their oil and all that. But this is starting to change. I'm not going to go through all these events. You can read through them when you get this, but this kind of chronicles, and it started before this, but I just took it from 2017. There's been massive movement in the gold markets. The central banks across the world have been buying gold at record paces, beating every single year after the next. And I think it's important that this is happening. You maybe see a headline or two about it, but you don't see that much on it. And at the same time, in March 2019, the Bank of International Settlements reclassified gold as the world's only other tier one asset. Up until that point, it was only the US dollar, which happened in 1944. So the US dollar was the only tier one asset from 1944 up into 2019, where gold is now a tier one asset. And then in 2020, the IMF, which represents 195 countries, declared that they want a new Bretton Woods system, pushing for that new system. In 2022, central banks bought the most gold on record. Well, guess what? In 2023 so far, it's pacing to be the highest on record. What are they preparing for? More on that, at least from what I think, here in a minute. The Belt and Road Initiative from China is growing, connecting Asia, Africa, and parts of Europe. Essentially, it's the old Silk Road route. It's connecting 75% of the human population and 45% of global GDP. It's the largest infrastructure project in the world. Everything in this is settling on the new Chinese digital yuan. And basically, it's the Panama Canal on steroids, and the US is really shut out of that. Now, remember, the crux of the dollar domination is the protection of the Saudi kingdom by the U.S. When the U.S. left Afghanistan in the way that we did, whether you agree with it or not, it sent a message because the next day, or actually the day that the U.S. exited, the Saudis signed a military cooperation agreement with Russia. This was done on August 24th, 2021. You can look it up. And so now Russia is protecting the Saudis as well. So the Saudis are hedging their bets. The next day, Russia signed similar agreements with others, including Nigeria. On August 26, 2021, Russia announced that all their subs now were equipped with hypersonic missiles, not to put a cherry on top of that. So to recap, major countries and central banks are hoarding and accumulating gold. Gold's being reclassified as a tier one asset to be on par with the dollar. The Chinese are building a global infrastructure connecting 75% of the world, freezing out the US and the dollar. And the Saudis are making moves to really decouple from US protection. In 2022, the world saw the US begin to weaponize the US dollar on a grand scale, kicking Russia out of SWIFT almost overnight because of Ukraine. Now, in doing this, the U.S. is actually undermining the currency because it's now stating who and cannot use a global currency. Now, there's a lot of debate around this, right? Russia's bad. Why we should be doing stuff to them. I agree. We should be doing a lot of things to them. But when you start weaponizing the dollar and using it as a stick to beat countries up, other countries see that and they say, well, what if I'm next? What if the U.S. doesn't like something I do, right? Global currency is meant to be used by everybody. And so that has started other countries looking at how they can decouple or how they can find ways to maybe circumvent the dollar. And so what that move did is it pushed Russia right into the arms of China that has the SIP system, which is a competitor to SWIFT, and it's being used by more and more of the BRIC nations. Russia and China are now doing trades for energy in the petro yuan. The Saudis are seeking entry into the BRICS. Petro yuan is immediately convertible to gold on the Shanghai Gold Exchange. See, I've been watching this for a while going, what are these central banks doing with all the gold, these countries? Why are they getting so much gold? And the pieces are starting to come together. And they're really coming together now with what is happening between last year and this year. The BRICS have announced that Egypt, Saudi Arabia, and Turkey is going to join them. At the same time, they announced that they're issuing a new reserve currency. At last year's meeting, they issued that they're going to announce or issue a new reserve currency. Now, they didn't say yet how that currency was going to operate, right? But they have now. If you think about it, though, logically, all this makes sense. You've got the U.S. policy pushing to decrease oil use and go green. And so the Saudis and everybody are looking at that going, why that doesn't help me. I need to expand, and make sure that I've got outlets, in case things don't go right between us and the US. Additionally, a lot of the Eastern European countries that repatriated their gold and brought it all back trade in their own currency. Those are members of the European Union, but they kept their currency. They're using it to trade, and they're on pace to break away. Even more is you've got the BRICS obviously expanding, but they just came out and they just finally said it. Russia, confirmed, and China's now confirmed this too, is the BRICS are creating a gold-backed currency. It's all coming together, believe it or not. The announcement release of that is this month. From August 22nd to 24th is the annual BRICS summit that they're having. A number of new countries are going to be admitted to the BRICS. A lot of people are speculating Saudi Arabia might be one of them. And they're going to formally release their gold-backed currency. Now, you've got it. Now it kind of comes together, right? Now we kind of have an idea. Why have all these central banks and everybody been hoarding gold? If there's going to be competitive the dollar that's potentially backed by gold, well, then that makes sense to have more gold. Now, here's the thing. This isn't going to change anything overnight. And the reason is because we've got the most robust, most developed, most mature bond market in the world in the United States. And so they have to build that, right? They're going to need to develop a bond market to go with it, right? That is liquid and everything else like what we have in the US. That's a huge advantage that we have, being the largest and most liquid bond market in the world. But what we may begin to see, and we've started to see this, in fact, I'll show you a slide here in a second on, but we've started to see a decline in the use of the dollar from a payments perspective. And if the BRICS do create a bond market and their members start using it, it's going to begin to take a lot more of market share from the US. And that means countries around the world may not need to hold as many dollars, right? So what do you think that does to our debt? In order to create demand for US debt, interest rates will have to go higher. So remember how we started with how world orders change over time, and that period between change is 10, 20, 30 years. Well, it looks more and more like we may be getting into one of those periods. So to kind of reiterate this, what makes a strong currency? Well, it's backed by some sort of commodity to ensure that it has value. And ironically, the BRICS are the biggest producers of commodities in the world: precious metals, materials, oil, rare earth metals, everything used in batteries for electric cars, all that. So the big domino that signals the fall is for Saudi Arabia to move to a basket of currencies such as the dollar, yuan, or the new BRICS-backed currency by gold, which is a new tier 1 asset, remember, for buying oil. When or if that happens, since every country on earth has had to own dollars to buy oil for 50 plus years, right? What do you think is going to happen with the dollar? Countries are going to decrease their holdings. They don't need them to buy oil anymore. And if dollar decreases or holdings decrease around the world, the dominance of the dollar decreases and erodes. And as this change happens, the consumer countries like the US give way to more productive countries and producers, and that world order begins to change. And this is just a slide that the US dollar has been losing ground over the last 25 years. We're at a 25-year low. And so that still, it's 60% of the market, right? So that's still pretty big, but we were upwards of 90% of the market at one point, right? So it's happening, right? Remember, how do you go broke? Gradually, then suddenly. So in studying history, it's amazing how these events really happen gradually. You just plod along and plod along and plod along, and then suddenly something happens. And almost seemingly overnight, people literally wake up one day to a different world and things have changed. And it's happened to the Dutch. It happened to the British, right? Overnight, Bretton Woods took away the pound's dominance and gave it to the U.S. dollar. Happened in places like Weimar, Zimbabwe, most recently Venezuela. Not that they were reserve currencies, but all of a sudden overnight, it's like, wow, inflation's 1,000%, right? So our job is to really be prepared to find the opportunity when or if that time comes. So, okay, what can the U.S. do to stop or reverse things, right? It's kind of like, okay, great. We know these things. They obviously, our government has to know this stuff too, right? So what can we do to maybe reverse this stuff? Maybe let's stop in this track. Let's go back the other way, right? And there is a number of things we can do. We can move quickly to improve the relationship with Saudi Arabia and ensure dollars, continue to be the currency used to trade oil. We can reverse the current U.S. oil policy and really start production. We are one of the top 3 largest producers of oil in the world, and we can be number 1 if we want to be, right? So if we go back to producing at a higher level, we unleash the economy, especially our commodity resources. We, can lower inflation, all of that. Nuclear is the cleanest form of energy and most efficient form of energy. It's more efficient than even oil or coal or any of that. And so nuclear would be a huge thing because remember, energy is the underpinning of everything for inflation. It goes into every product just about that you use, obviously cars and everything else, right? So if energy comes down, that lowers the price of things. Focus on incentivizing productivity of the country through business tax incentives, tax reductions for workers, stop printing and spending excess money, fueling inflation, potentially cut the size of government, work on achieving a budget surplus, stop weaponizing the dollar, work with other countries to stop Russia's aggression on the world stage and others for that matter, but don't scare the world away from using the dollar as the reserve currency. Instead, work across the world to bolster dollar adoption further. We want more people using the dollar. Be careful not to go to war if China, Russia begin to make bigger moves, unless we play to win. We've seen that before where, we don't play to win and we get stuck in it, right? And we're at that point where these guys, especially China, has a bigger navy than us now and everything. So we have to be very careful there. And then go back to sound monetary policy and limit the Fed intervention. Sadly, none of this is likely to happen. So what can you do to thrive in the years to come? That's the real question. Well, the first thing that you can do is you can understand the truth about money. In today's world, remember, all money is debt. Your money is someone else's debt. Money left idle loses value to inflation, 2,300%, right? So your money is just every day losing value to inflation. And so paper money is often called currency, and it's called currency because like a current, it has to move. If your money's not moving, it's dying. And that's the dirty secret of the Fed. They love and they want inflation because they can pay back that ever-growing debt with money that's worth less and less. But that hurts us, right? So got to keep that money moving and working for you constantly. Price floors, they're now higher, right? We went up 10% inflation and now we're growing 3% on top of that, and we're calling that a win, right? And so now we've set a whole new floor for the cost of things, right? They're going to continue to rise over time. The rate of inflation is much higher than the published numbers. And you have to ensure that your money is really moving and staying ahead of the Fed. In addition to that, okay, watch for signs that things are happening with the BRICS, the WEF, adoption of CBDCs, didn't even get that into that today, to bring about the changing order and monetary system. It's prudent to have some gold and silver. Make sure some of it can be used as a medium of exchange. Quarter gold eagles are good for that, silver dollars. Stock markets are going to continue to have positive drift, but we're going to have more frequent drawdowns, right? Just think about the last couple of years of what the markets have been like, right? So you got to learn to be an active investor. You got to understand that changing market character. Consider investing in and accumulating tangible assets, including commodities. Consider investing in cash flowing real estate backed assets. We saw what's happened to real estate prices ever since 1971. Consider investing in cash flow generating businesses with strong management. Ensure that your currency is working for you. Do not let it sit idle. Even if you've got money in a bank, consider putting it in like short-term investment debt. Yes, like 3 month, 1 month, even 1 year treasuries where you can park that and get some, at least some interest to keep up on it. And then maximize your personal productivity. Focus on results, leverage your time, make sure you're getting the most out of the time you're putting into your work. Ensure that you set up your financial system for tax efficiency, right? Preparing for tax increases. So maybe a good time to talk to a tax professional and really make sure that you're doing things the best that you can for yourself. Pay close attention to the platforms and policies of those you're voting for as they affect all this. Get as healthy and in shape as possible. Above all, keep your head and your wits, right? If one side's losing, another side's winning, how can you be a part of that winning side? Right. And in light of all that, chance favors the prepared mind. Our goal at 12-minute and ahead of the things happening on the world stage to preserve and maximize your wealth. We keep our money moving, generating cash flow through our strategies, and we're always looking at how we can make our services better and give you everything that you need to thrive. So with that said, I have several big announcements for you guys tonight, and I really thank you for sticking with me this long so you can see these and what we're doing. First and foremost, big announcement number one. For those of you that are new to 12-minute trading, maybe it's been a little while and you're coming back, or maybe you've just been on the fence, we want to make it easier for you to learn more about what we do and to see if it's right for you by giving you a free 1-month trial to both Doc and I services, as well as a massive discount up to 30% off when you continue. It's the best offer that we've ever given on the services, so you can take advantage of that, but you can try it for a month. You can dig into both Doc and I services, attend Doc's daily trading room, see how I operate things with my weekly newsletter and then my updates and my midweek and all the stuff that I do, and see if it's really good for you. And if it's a fit, awesome. If it's not, we totally understand. So you get 1 month to try all of that out. And all you got to do is go to 12minutetrading.com/bundle trial. All right. Big announcement number two. Students, you guys are going to love this, right? In today's age, things move fast and they continue to move faster, especially in the markets. We're always looking at how to maximize our services for students, especially when it comes to delivering our content. That's why we've got our student portal. We do text and email alerts every time we make a move, but we know people are also on the go and not always in front of a computer. So I'm excited to share that we've finally done it. I'm excited to release the first version of the 12-minute trading mobile app powered by our portal partner Thinkific. The app is currently only for Apple devices though, and it functions very similar to what you see in the portal, but you now have everything at your fingertips and on the go. And the mastermind groups had access to this for a little over a month or so. They've given me some great feedback, especially when it comes to taking advantage of like text alerts, right? They can go right in, pull it right up on the app, see it instantly. You can just scan the QR code to get it. And remember, you're going to download the Thinkific app, and your username and password that you use to log into that portal is going to open up 12-minute trading on it for you. So that's what you're going to do. It's not going to be an app that says 12-minute trading. So it's really important you understand that. But you're going to get a copy of this presentation. So if it's not working for you right now, don't worry. You're going to copy. You can go scan it. You can do it later if you like. All right. Big announcement number three. Trading is a lonely game, and it's a hard one. And Doc and I are really looking always, to be here for you through our services, our live sessions and that, but we also feel it's important to have a place where students can communicate, help each other, as well as collaborate. So you will notice if you're a student that you now have access to the 12-minute trading community. This functions a lot like a forum where you can talk to other students. There's different topics in there, and it's turned on for everyone now. So you can go in, there's certain sections. There's one for each and I Doc services, as well as for general needs, trading topics, and that. So Doc and I will be spending more time in the community. We'll be sharing more insights there. We'll answer questions in there. You guys can connect with other students and talk about ideas and everything. I'm really excited to finally launch this. I think it's really going to help enhance the education and experience that we provide to all students. So really excited for that. So if you're a student, when you log in, you'll see you have the access. Go on in, have a little fun with it. Say hi to me. Follow me in there. You can follow others. It's a lot of fun. So check it out. All right. Lastly, and really maybe most importantly for today, You've heard me talk a lot about the mastermind group, everything we're doing together. And obviously I shared some of the advanced work that we've done with the group really to stay ahead of what is happening, throughout tonight. This group is extremely special to Doc and I, as we're not just working on trading related items, but really working together to better ourselves as a whole, build our wealth together. The folks in this group are truly committed to taking themselves to the next level, and we're doing it together. And that really goes with our mission, right? Our mission is to create an environment that fosters lasting relationships and to improve as investors through sharing best practices, resources to help each other grow and thrive. And our vision is through fulfilling that mission, we're going to create a better quality of life for ourselves, our families, those around us, reaching levels of success previously that we maybe thought were impossible, right? And as I said when I started this group, that I absolutely wanted it to be world-class and that I was limiting it to only 10 people. And that's exactly what it is. The mastermind meets for 2 in-person events per year for 3 days. These events are held in 5-star resorts with 5-star amenities with just about everything included as part of the membership. Each event is a blend of world-class experiences, guest speakers, investors, and training on advanced trading techniques that we don't typically do in the standard services. And in fact, the pics on the screen you can see are from events that we held in places like Atlantis, Bahamas, Sonoma we did in the spring, in Wine Country, Universal Studios. And the mastermind groups also meets every month as a group to improve our investing skills together, share best practices as a group. We have special guests and also review and release the tools that we are using to help us increase our success in trading. You've heard me reference some of the tools we used before. Doc and I also do private one-on-one coaching sessions with each member, multiple times a month in some cases. And we're personally available to members through our direct contact for any needs at any time. And we all have a lot of fun communicating almost every day through our WhatsApp group, sharing what we're seeing and doing in the markets. I also bring wealth partners and a network of alternative investments that we participate in into the group as well, and special offers that they get just for the mastermind group. So we've got everything from real estate to oil and gas and other things that we invest in through these partners, providing excellent returns. And then additionally, there's opportunities to invest as a group into unique projects like our Accelerate Ventures Fund that we started last year that invests in e-commerce and digital assets and so on. I know there's members that are on the on today. Thank you guys for joining. Thank you guys so much for your support. Feel free if you want to type any thoughts on your experience into the chat box, people can see it, go ahead. But for 2024, I'm going to allow this group to expand to 15 with just 5 more spots. One of them is already taken, so there's 4 left. The cost is $14,997 per year, but this includes not just everything I shared, but the accommodations, breakfast, lunch, private luxury meals, experiences, all of that, the in-person meetings. The next one that we have is at the iconic Broadmoor Resort in Colorado Springs this fall. So it's pretty awesome value. And we encourage members to bring their families and make them a part of the events. And so people bring their kids. I bring my daughter and my wife. It's great. For those that are interested, as I mentioned, there's 4 spots for 2024. If you sign up and pay your deposit by August 30th, you're going to get a special discount of 20%, making the price just $11,997. You're going to save $3,000 just doing that. So I realize this isn't for everyone, but if you are interested, I urge you to please go to www.12minutetrading.com/mastermind. Fill out the application as soon as possible because I'm going to take people in the order that they submit their application. And I have a feeling that those 4 spots will probably fill up pretty quickly. Remember, just for reserving your spot by August 30th, you're going to get 20% off, a $3,000 savings just for acting this month. So now it's time for Q&A. I'm going to come back on video. You guys should be able to see me now. Doc, you can come on video as well. You can see there's the 2 links there for those things. If you want to try the services, if you're interested in the mastermind, I think people may already be getting in and testing around playing around a little bit with the community, which is cool. But questions, please ask away, guys, and we'll go from there. All right, let's see here. Is there going to be a link where you can access? Yes, there'll be a link where we can access this. Students will have it in the portal, and then we'll actually make sure to send it out for everybody as well, too. So, good question. Any other questions? Doc, anything I missed that you think is important that these guys know?
I think what I found over time is that, and I found this myself, is that I think this is an extremely difficult business to run by yourself, right? To be a
Yep.
retail trader without some kind of a wolf pack to run with. So whether it's online or whether it's in person or whatever, and be very selective about the wolf pack that you join. Don't just, jump onto Wall Street bets and think that you've joined a group of expert traders, but it's people that are going to challenge you to be the very best that you're going to be. And so what I found, my experience and the limited time that I've been, associated with your mastermind is that, the people in that wolf pack are very, very good.
No, they are a great group, guys, and I meet with everybody that is looking to join the group. Not everybody is a good fit. Honestly, we try to keep this group really close knit and tight. It's very much like a family, and so I actually have a pretty deep discussion with everybody who puts an application in, just to just ensure that we are a good fit, that our values align, and that we are really set for that mission together with that. So. Oh, you're welcome. Somebody said thank you so much. Yeah, you're welcome. Thoughts on crypto from David. Doc, I'll leave that to you. I just buy a little bit of crypto and just keep it in my wallet. So I only do like Bitcoin. So I don't do much in that space. What do you got?
My read on crypto right now is I wouldn't worry about chasing after, the next 100x altcoin or anything like that. Follow the top two, which are Bitcoin and Ethereum. And those will be almost like your offensive linemen. They will make the breakout and will pretty much, once they break out, then that will kind of open the floodgates for everything else. So we've got another halving coming up on Bitcoin next year, and typically the market will rally into the halving of that. So we're just about due. So I would say just basic, simple dollar cost averaging for right now is the way to go. And then
Doc,
just stay invested for the next run.
Doc, have you seen, like you and I've talked a lot behind the scenes about it. There's some really tricky ways that you can essentially sell options on crypto, like selling puts against Bitcoin and stuff. Has there been any strides in that? Because it was, almost so convoluted. It was almost impossible for people to do unless they were tech geniuses. Has that changed at all, or is it still pretty much the same?
No, well, the main problem right now with the crypto trading industry has been the SEC has been on, just a tear trying to destroy all the US based exchanges. So for the reasons, I mean, you didn't really get into CBDCs,
Right.
but I think there's a very real probability that the US wants to go down through that route, and they view crypto as kind of a competition to that. So they've been,
Sure.
they figured it out in the last couple of years, like, oh wow, crypto is a threat. So they've been really, I mean, like Binance US, they went after them. They're going after Coinbase. They basically took Bittrex, and Bittrex said, we're out of this. We're going to go
Mm-hmm.
international. So a lot of companies, a lot of exchanges are moving in that direction. Of course, FTX was,
Right.
a big
A
event, but
sham.
yeah. So
But
but yeah, you can. There's actually a brokerage where you can sell cash secured puts on Bitcoin, and it's physically settled too. The hardest part about that is you have to wire the money in. There's no ACH, but
yeah.
it's surprising. I mean, there's a lot of parallels. I'm seeing the crypto market as being in the same space that the equities market was in terms of just the maturity of things, like maybe 40, 50 years ago. So
Yeah.
you're still really, really early into this market.
Yeah, the nice thing about that, I would say, is that charting crypto and really being able to, like, we talk about, we look at technical analysis and everything in the markets. We just talked about the different market characters and stuff that happen, but there's a lot going on, with the mature markets that we have. There's obviously there's the Fed. There's all these things that can affect it. Crypto is more of kind of that true just wide open capitalist market. And so I think it trades more traditionally, I mean, you tell me, charting that market and really being able to play those trends seems to be like it may be more pure, if you will, than the traditional markets nowadays.
Well, the one thing that we had to get used to when my son and I first started trading crypto like 6 years ago was that it never shuts down. It's always open. There is no like, oh, there's no closing bell, there's no weekend, there's no nothing like that. So it's a very interesting market.
Yeah, in some ways it's like futures, even though those closed down a little bit even too. So great. All right, we covered crypto. Any other questions from anybody out there? I know we have taken you a long time. We've covered a lot of ground. You're going to get obviously this presentation. You're going to get you're going to see the replay of this. We'll have it posted up. We're going to get it up on the YouTube site too. We'll probably clean up a few things in it and get that out there too. But if there's no more questions, I just want to thank everybody for attending. Like I said, I really hope this event was valuable for you and that you got something. Just kind of in the thick of it and everything else. And so I hope that you got a lot from it. And I appreciate you. And I know Doc does. If there's any other questions that do come up, if you're a student, you can ask us in the new community, or you can always send us an email through support on anything. If you are somebody who's looking to kick the tires a little bit, check us out at the free trial on the bundle. And then if you're interested in that mastermind, send through your application, even if it isn't for you, but you think maybe there's a chance that it might be, give it a shot. We'll do a call on it. We'll see if it makes sense. But other than that, thank you all so very much and have a wonderful rest of your evening. We look forward to succeeding with you throughout the last half of 2023. Thank you guys so much.
Thanks, everybody. Good night.